All right, good morning, everybody. Again, today we're going to be talking about capital gains sales tax, or sorry, not sales tax, capital gains tax, right? So again, what is capital gain, right? That's the first thing is question that you should have. Anything held more than 1 year. So this goes same thing with stocks, but we're not going to talk about that. We're talking about real estate. So if let's say Avatar is a real estate flipper, right? He buys and picks it up and sell. Usually that's less than a year. So whatever profit he has after expenses, he's going to be taxed at the normal rate, which is whatever income tax rate he's in. And in California, most people are over the capital gain tax rate. Okay, so we'll talk about what that rate is for anything held more than 1 year. So just remember, 1 year. Okay,
Not two?
1 year.
What is the
One-
2
one-
years?
Okay, that's capital gain tax. The 2 year that most people are thinking about is to get that exclusion. So we'll talk about that next. Okay. So again, capital gains tax is payable whenever you make money. It's just like when you when you get a salary or income, you pay income tax, right? When you have real estate, you pay property taxes. Got it? Okay. So there's always a tax somewhere, you know, either federal or state, right? There are some states that don't have income tax, like Florida, I think Washington, South Dakota, right? There are some states that have lower tax. California is the highest one that has the highest income tax rate out of the 50 states. Okay, but especially in the Bay Area, why do we live in the Bay Area?
Weather?
Whatever the reason is, whether your income, whatever, right? Okay, so again,
True.
some people says, well, we pay so much taxes. Well, the tax that we pay is the tax for living in the United States, right? That's why when people talk about the US is bad and all that, I always say, well, get out.
Yeah.
Right? You don't like the US, then get out or do something about it, right? Stop complaining about it, right? Bottom line is like the tax is, if we make money, we got to pay something. Yes, I don't like where the money is being spent. That's a separate issue.
Yeah.
That's a political issue, right? But understand this, we all have to pay taxes. So figure out that how to lower it, right? How to lower it.
You get with the program and get a boss.
Yeah, right? Yeah. Okay. Right. So again, our job here, as far as capital gains, is to figure out what it is and how to lessen it. So we'll talk about different ideas on that. Okay. And then tomorrow we're going to talk about how to lower our income tax. Right. We talked about how to lower our property taxes a couple of days ago. Today we're going to talk about how to eliminate or defer or lower our capital gain tax. Right. Tomorrow is about income tax. All right. So what is capital gain? What you need to know. Okay. So here's the first thing you need to figure out. What is tax deductible? On your primary, right? Primary meaning it's your main house, right? You can deduct the interest on the first $750,000 loan, okay? On all your personal use homes. So if you have a second home in Tahoe, second home, okay, is different from a vacation home. Okay. So $750,000 loan. It used to be $1 million, right? On the first and second. Now it's $750,000 for both.
I didn't even know that. I
Yeah.
thought you could deduct the whole thing, even if
Nope.
it's more than 750.
If you use TurboTax, it'll tell you limited 750. Property taxes are only limited to the first 10,000 only. Okay. For most of us, ours is over 10, right? Unless you bought a long time ago, right? Okay. Again, first and second homes, right? This is first and second, not vacation, not Airbnb, not rentals. Okay. What's not deductible are HOA dues, homeowners insurance, right? Any insurance is not deductible.
Oh, really?
Okay, on your primary, okay, and your secondary home, what we call personal use homes. Clear? All right. Now, what is capital gain tax? Okay, this is tax applied on profits on a sale. When you sell, you pay tax. Okay, we're primarily talking about primary here. Okay. Short-term capital gain, we talked about that, right? Held for 1 year or less. Okay, so if you hold it for more than 1 year, it's now available for the long-term capital gain tax, right? Short-term capital gain tax is your income tax, whatever your rate is. Understood? So long-term, federal is either 0 because you have no profit. It's either 15 or 20%, depending on your income. Okay.
Oh,
Right. So it increases every year. I think this year it's like 450 something thousand, right? So we're not, talk that to your accountant. Okay. So if you hold it for more than 1 year, you qualify for the 20% rate instead of like the tops that right now, as of this year, the top federal rate for income is 35 point something, okay? Like 35%. Okay. 2026, the Democrats are thinking it's gonna go up, higher than that. Federal, okay? State of California, the highest rate is 13.3 for any income or profit of more than $1 million total, okay? So when you sell a primary home, right? If you have to pay capital gain rate, it's gonna be 20%, 13.3 plus a 3.8 is what we used to call this the Obamacare, because he's the one that approved it. It's called the Healthcare Tax Reform Act, which is what's supposed to make medical insurance available to to the masses,
Oh, that's what it was.
right? So whenever you make more than 250 on the house, you have to pay that extra 3.8%. Okay? So when we talk to our clients, it's their primary residence, we said, hey, do you know what your capital taxes are going to be? Have you spoken to your accountant about it? Make sure you talk to them, do you qualify, you're gonna pay 20% federal, 13.3 in California, and maybe that extra 3.8. Please make sure you check with them. This is on our primary. Okay, got it? How is capital gains tax calculated? You have the adjusted cost basis. Typically what that is the purchase price plus any capital improvement, not maintenance. Okay, if you decide to remodel your kitchen, unless it's a capital improvement, what does that mean? You have plywood and, let's say granite countertops. You replace it with the same thing, that's maintenance. But if you're gonna upgrade it, like you're gonna put more expensive stuff, then part of that becomes a capital improvement. Got it? Are we sure? Are we clear on that? Okay, capital improvement, typically, most of the time, it means it's something better than what you have now, where it's an improvement. Changing carpet to a thicker carpet is not improvement. It's not capital improvement. Primarily what we're talking about is adding square footage or adding real value to the property. Changing from a wood shake roof to a 100-year-old metal roof, that's a capital improvement, okay? So that you can add to your original basis, right? Original purchase price. Hold the question to the end, okay? So remember what that question is, okay? So remember, to calculate it, it's very simple, right? What you sell it for, current sales price, minus adjusted cost basis, minus, what other closing costs are, okay? Equals profit. Are we clear?
Oh, okay.
So you know how the profit is, right? Question, Carolyn? You forgot?
Yeah, I kind of forgot.
Okay, all right. Okay, make sure you guys write down your questions, right? Okay, so you should know how to calculate capital gains, right? So that's your gross. Now, IRC code section 121, IRC, what does it stand for?
Internal Revenue Code.
Internal Revenue Code, right? The IRS Revenue Code, right? The Internal Revenue Code, right? Okay. IRS Internal Revenue Code, that's what IRC is, okay? Okay, so the IRC 121 says, right? You can exclude the first 250 of your profit if you live there 2 years out of the last 5, right? So if you go back 60 months, is this your primary residence 2 years out of the last 5? If it is, then you don't have to live there 5 years, okay? You don't have to have 5 years. You can do this every 2 years. And some of my clients are serial movers, right? Where they pocket. Where can you pocket 250 every 2 years? There's not a lot. Of course, the market has to keep going up, right? And in the last 10 years, the market has been going up, right? Now, for some areas, 250 is a lot of money. For some, it's not, right? Because some homes, I have clients, so their homes have gone up 250 in like a year, because it's multi-million-dollar homes, right? So it's all relative. Okay. So just remember the 250 per person, because if Mike, Carolyn, and I, we're all friends, we bought a property, we can now technically exclude the first 250 per person, right? I had one client, they were able to exclude the first $1.5 million,
Wow.
because there were 6 of them,
Okay.
3 married couples. Okay.
Can you do an example with math, including like?
Yeah. We will. Okay.
Maybe that'll be.
All right. Okay. So just remember that. Okay. So now, what is deductible, right? Oops. I think I missed the slide here. Okay. Okay. All right. So hold on, my slides messed up. Okay, I got the wrong one. Okay, all right. So just remember IRC 121, right? So that's how you can exclude the first 250. So how does that work, right? Let's say Mike bought a house 10 years ago for 500. 500,000 is his basis. He didn't make any capital improvement, right? He didn't add his square footage, right? So his basis is still 500,000. He sells it now for $1 million, right? Let's just say expenses are 50,000, right? You know, commissions and all that, right? 50,000, right? So what is his profit? 1 million minus the 50
Yeah.
minus the 500.
450K.
So profit is 450 basis, right? I mean, that's his gross profit. So does Mike qualify for the section 121? Is he single or married? Right? Who's also entitled? He's still single, let's say, right?
250.
Right. So he deducts the first 250. So what's taxable?
200.
200,000 is taxable. Does that make sense? So do the math, right? Right. And that's how do you determine it? What you sell it
Oh,
for
I see.
minus basis, or which is how much you bought it for, minus expenses, you know, minus capital improvements if you have it, right? Okay. So clear?
So, and then can you calculate so 200,000, so I get taxed on the 200,000
Right.
depending on my income bracket.
Depending if you qualify under, you know, so we're gonna review that, okay? So just remember that, okay? So,
Sounds like a big saving.
well, basically, right?
Yeah.
We talked about this earlier, right? Is, okay. Okay, the rates, right? So because you held it for 2 years, right? You automatically qualify for the long-term capital gain, which is the 20%, the 13.3, and the 3.8, if you have to pay that. In this case, I don't know what other income Mike has,
I see.
but if he has no other income, he doesn't have to pay the 3.8
I see.
because his income for that year is the 200 gain plus whatever, 0, let's say, right? So 3.8 only applies for your income and profit is above 250 total.
Oh, okay.
But we're not gonna quote that. We're gonna tell our client, say, check with your accountant about this.
Okay.
Okay, all right? Because again, we don't know what they claim, what they deduct on their income tax. We don't
So
know
they
that.
Only have to pay
Right.
federal and
State,
California, yeah, state.
Okay.
But the 3.8 is possibly
yeah,
not
gone,
relevant,
right?
yeah.
And again, the 20 could be 15, right? Depending on their income, right? And the 13.3 is $1 million income and profit total. So if their profit is only 200, it's probably at 8.3. Okay, but we're not going to quote these things because we don't know what their AGI is, right?
Oh, I
Okay,
see, okay.
right. So just remember that this is what the rates are, right? So you know, so if someone says, "Hey, I want to sell my property," they could potentially pay at least a third. You know, at least this. I know it's more than a third, right? It's like, you know, almost 37%, right? You do the math.
Yeah.
Right? But most likely it's about a third, okay, roughly. Okay, all right. So that's what if you make money in real estate and you held it for more than 1 year, you qualify for this rate. If you held it for less than a year, like, you know, if you're a flipper, then you're gonna pay your income tax rate. And in most people, like for me, you know, 20% federal. I mean, I wish I was at that level, right? Because most people are above that because, you know, if you make 100,000, you're way above the 20% already. Okay, and the top rate is 35%. And remember, tomorrow we'll talk about income tax. You know, if you hit another level, right, only that portion that passes that tax rate is taxed at that rate. Everything else is taxed at the lower rate. Okay, you know, it's like a step. Okay, so if you don't understand that, don't worry about it.
Yeah.
Okay, this is not the time to understand that. Okay, so just remember the tax rates. These are the maximum rates. This is what we tell our clients. And again, it can be lower. Please check with your accountant. Right? There's a sheet that I'll share with you tomorrow.
Why do you
guys-
say this is the maximum rate? You just said 35% is the highest rate for federal.
No. Typically it is. But if you add this, right? If you add all this, what's the
Oh,
number?
yeah, 37, okay.
37, right? Right? But it's rare. I don't think I've ever had a client that hit all three.
Yeah, because, so I just did the calculation, so you said, if I bought a house for 500K, I sold it 5 years later for 1 million. And then I only added the federal in California, my outcome, I made 134,000.
Probably, yeah.
As
Yeah, that's what you walk away with.
I see, yeah.
Yeah,
Okay.
okay, all right. So again, figuring out what your profit is, right?
Yeah.
And we talked about this earlier. How do you figure out your profit, right? How to figure out your capital gain tax, right?
Okay.
If you look at the bottom, calculate capital gain tax, right? Current sales price, what you sell for, in this case, Mike sold it for $1 million, right? Minus his adjusted cost basis, what he bought it for plus improvements. In this case, he didn't make any capital improvement because he didn't add square footage or substantially increasing the value, right? Remember, updating the house, remodeling may not qualify, right? Because if you're just, changing carpet for a better carpet, that's not upgrading,
I see.
right? That's not a capital
So
improvement.
if you remove an old kitchen and put in a new kitchen, that's also not.
Typically not, unless that kitchen is now, that kitchen, if you were to do the same thing, it's only 10,000, but now you put a $50,000 kitchen,
Mhm.
It's a chef kitchen now, you can potentially add that to your basis,
Because
right?
farm law said
Yeah.
that if you do your kitchen, it doesn't really increase your taxes.
It depends what kind, okay? It depends how much it is and is it a capital improvement, right? Okay, so again, that's property taxes. And we're talking about capital gain taxes, right? So in Mike's case was $1 million minus the $500,000 basis,
Mhm.
minus $50,000 closing costs.
Yeah.
His capital gain starts at 450 because he's lived there 2 years out of the last 5 because of IRC 121, right? He's still single. He can deduct the first 250, so 200,000 is taxable. Let's just say he hit the max, 20%, 13.3, 3.8,
Yeah.
right? 37% of that 200 is taxable at that rate. So which means that he's gonna walk away with about how much?
Well, I didn't calculate the
200?
extra
You just did.
3%.
Okay, so if you do the 37%,
Yes.
right?
Yep.
Okay, so he's gonna walk away with roughly about, no?
200 times 37%.
Yeah.
Minus
From the 200.
34K.
Yeah.
Minus
So about 120 something, right? That's what he's gonna walk away with,
126.
right? He has to pay the government somewhere around 70, 80,000, depending on what his rates are, right? Okay. So Mike got this idea. Maybe I should get married this year, right? So now I don't have to pay the government, $80,000, right? Here's the thing though.
Oh, really?
Here's the thought, right? Yeah. He said, "Hey, Carolyn, want to get married, right?" Right. So again, that's an interesting idea.
Yeah.
They can't take the 500,000 now this year because number one, they have to be married, filing jointly for at least 2 years out of the last 5. So you have to be married to her for at least 2 more years. Can you survive a divorce in the next 2 years? Because otherwise, she's taking half of everything, including that first 250, right?
Yeah.
So yeah, I make that a joke to my clients because some of them have that. Hey, what if I get married, Greg? I said, well, that's an interesting scenario. You're not the first one to ask me that. Let's talk about it, right? Yeah. So yeah, I know people that they regret getting married after a year.
Oh, really?
No, yeah, because
How
they
big, how
lost
fast?
half their
How
equity.
fast did they get married though?
No, I mean, some people,
You never know.
I've met many people.
Yeah.
I have many stories, right?
Not pay taxes.
Where-
Marrying just
Hey, the honeymoon is fun.
Yeah, yep.
You know?
And then the real one, the real
Yeah,
person. comes
after,
up.
right? So again, it's that, right? Yeah. My wife, I always, I start, tell you about my wife, right? Right. Anyways, that's another story. Anyways, let's move on, right? Yeah. Okay, so let's talk about this, right? So yes, there is ways, right?
Yeah.
Some people say, well, what if I add my kid?
Yeah.
Right? Potentially. To qualify for this 250, you have to be on title. Unless you're married filing jointly, then the spouse doesn't have to be on title. But if you're gonna add your kids, mom and dad, and they want to qualify, they have to meet the test. You have to be on title for 2 years out of the last 5, and you have to primarily residing there 2 years out of the last 5. So here's the next question. How does the IRS know? Your tax return. It typically has an address. And in there, you'll be claiming interest deductions. All right? So if you're not taking interest deductions, the IRS doesn't know that you own any real estate. Does that make sense? Right? Okay. So with technology these days, all this is automated. So there's red flags that happen.
What are interest deductions?
Interest, well, when you borrow money from a bank, the interest that you have, right? Remember the first 200, we go back to our first slide, right? Remember? interest
Oh,
costs,
I
right?
see.
So when you borrow from Chase at 6%,
Yeah.
right? That 6% interest is deductible,
Oh, I see, okay,
right? Up to the limit
okay.
of the loan. So if Mike borrows $1 million loan, gets $1 million loan, only the interest on the first 750 is deducted. How's that calculated? It's somehow calculated, okay? Because there's when you do your accountant, they'll do the math for you,
Okay.
okay?
So if you were to add your kids, right, for example,
Mhm.
they wouldn't be on the loan.
Doesn't matter. It has nothing to do with the loan. It depends on who's on title and who's been claiming it on their tax returns. That's their primary. How does the IRS know it's your primary? They'll say,
Yeah.
where's your driver's license? And that's because that's where you vote.
Right.
Do you have utilities that shows it? Now, your kids may not have utilities, it's your own, but that's okay. Where's their driver's license? You know, where do they send their cell bills? You know, the IRS will know these things.
Yeah.
Or they'll knock on your neighbor. Hey, does Carolyn live here? Who? I've never seen that lady, right? They have done that. The
Yeah,
IRS
yeah,
has
yeah.
done that. Okay, lenders have done that. People will knock on your neighbor's house. Okay, so again, you know, they will know.
Yeah.
So like I always tell you guys, especially the married people, if you always tell the truth, you never have to remember what you said.
Yeah.
Right?
Yeah.
Because one lie builds on another lie, right?
You have to
And
keep
then you have to
going.
remember, right?
You
Right?
have to
So,
keep going.
yeah, so married people, right? Tell my guy friends that. Okay, all right, so, right, okay. Oh, I didn't realize that my camera's not on, okay.
Makes sense.
All right, so Zoom roll, okay, all right. Okay, so you guys know what's deductible, right? So on my investor class, okay, which we're not doing today, but on my investor class, I tell you guys, the reason why you buy rental properties is so you can deduct the bottom, right? It says what's not deductible: HOA dues, homeowner insurance, mortgage insurance, maintenance. It's only deductible if it's a investment property,
Oh,
meaning
really?
Airbnb, meaning it's a monthly rental, your lease, right?
Yeah.
All of these don't apply on vacation homes. Remember, the deduction is only for first and second home. Well, isn't a second home a vacation home? No. There are three types of homes: personal use homes, first and second. Then you have the investment, rentals, Airbnb. There's the middle one for rich people, which means it's a third home, it's a vacation home. What's a vacation home? Something you don't rent.
Not a second home.
Are we clear? What's a third home? Well, you can only deduct the first two, so third home, you're rich. That means you can afford 3 houses. This make sense? Are we clear? You can afford the fourth house. No deduction whatsoever. Okay? So there's certain limits. You're lucky you have the second home. Okay. So for now,
Yeah.
but here in the Bay Area, 750 loan takes up a lot already,
That's what
right?
I'm asking, what's the benefit of having so many homes?
Well, you're rich,
Yeah, you don't care.
right?
You have money.
Why do you have multiple cars, right? I mean,
Yeah.
same thing, you know?
Oh, really?
Yeah, so there's no benefits to that.
Mm.
Are we clear, right?
Mm.
So this is how the tax law is written. They don't, technically they want to tax, or the rich to pay more, right? But again, it's all relative in my opinion, right? Okay, but so yeah, so the IRS says, or the government says, if you can afford a third home, a vacation home, then you don't need any tax advantage. But there are other ways to buy a third, fourth home, and have tax advantages. Okay, there are ways by putting it into an LLC, corporation. Okay, Donald Trump, his multiple properties are not owned by him personally. It's owned from international. So as a CEO or whatever position he holds, he gets to stay there as part of being an employee. Right? Okay. For instance, in Terrell, we used to have a vacation home in Tahoe, right? And we would allow agents to use it.
Really?
Right? So we deduct as a company, as a perk, we had agents using it, right? And so again, you guys, it doesn't cost you, but for us, it costs us, but it's a deduction. Okay, so tomorrow we're going to talk about how to make your life tax deductible. It's going to be a fun class, right? But first, we're going to talk about how to stay motivated. In order for you to stay motivated, you have to think about what do you want to do with that money. Then now we talk about how to deduct some of those things. Okay, all right. So again, primary homes, right? And second homes, which is personal use homes. Okay, that's how you have to think about it. Investment, you can deduct the bottom. Okay, this is where tomorrow you'll figure out why, as a real estate agent, you should be real estate investors first. Okay, so you can deduct a lot of stuff. Okay. All right. Um. Okay. So you know what's deductible, right? So investment, everything's deductible, right? So if let's say, someone has a rental property in Sacramento. Every time you drive to Sacramento for gas and maybe stay overnight, can be tax deductible, right? So that's what we'll talk about tomorrow. How to make that trip deductible? Or if you have a rental property in Hawaii, every time you go to Hawaii, how can you make that trip tax deductible?
Gosh, I
Right?
need to buy a
Or-
home in Hawaii.
Mike says, I'm thinking of buying a house in New York or in Florida. So
Yeah,
he's gonna do a research trip, right?
Hmm,
How can you make that tax deductible,
I like that.
right? Okay, so you
So
don't
you
have to
gotta-
own
Yeah,
or
yeah.
buy something to make it tax deductible, right? So as a real estate agent, we have these opportunities, right? But here's the thing though, you have to have income to deduct from.
You can't just not make money and try to.
This doesn't make sense, right?
Yeah.
Okay, so that's one of the things we'll talk about tomorrow also, because business planning, right? Because yeah, for instance, right, like I have some clients who work for the airlines, right? They get to fly for free or very little. But then they say, but when I get there, how am I gonna afford when I'm there? Or, there's expenses and all that, or I can't take time off. It's the same thing here. We got all these deductions, but if we can't take advantage of it, what good is it to me? So that's where you have to think outside the box and either create that income, create that motivation. So that's what we'll talk about in the first part of tomorrow's meeting is, what are you gonna do with the money? Do you even have trips planned? If you don't have trips planned, how can you figure out how to make it tax deductible? Right? When you say, I want a new car. Okay, great. What kind of car? I don't know. Well, you gotta think of the car first. Is that me or somebody else?
Yeah.
Okay, all right, okay. So if you don't know what kind of car, then we can't figure out how to make it, a good tax deduction. Like what kind of car should I buy? Well, it depends. So we'll talk about that tomorrow.
Yeah.
A little bit. Again, these are concepts, right? Okay, so you guys got that. We talked about that earlier, all right? So what's deductible, right? This is for primary. On the bottom is if it's an investment. Second home, vacation homes, third and fourth homes have no benefits, okay? Whatsoever, nothing, unless it's in a corporation, okay? We talk about capital gain tax, right? So this is tax on profit, right? Okay, and as we talked about, short term is 1 year or less, right? Over a year, long term, right? Most of our clients, it's going to be long term because they're going to hold it for at least a year, right? The 2 year that a lot of people are thinking about, okay, so this is the rate,
That's where you
right?
can live.
Okay. The 2 year thing that people are talking about most of the time is this thing, okay, section 121, where you have to live there 2 years out of the last 5, right? Doesn't have to be consecutive. You just have to find, you can claim anything on your tax return. Can you survive the audit? If not, you're gonna pay a penalty. Hopefully it doesn't land you in jail.
Yeah.
Right? Because I always say, right? Know the rules, play by the rules,
Yeah.
spend some time in the gray areas, but don't go to jail. It doesn't. Oh yeah, I forgot one more thing. Make lots of money and then don't go to jail. All right? Because if you got to know the rules. You got to know the rules or hire someone that knows the rules.
Yeah.
Right? Okay. So section 121, IRC code, right? Internal Revenue Code. Okay. That's what IRC stands for. Okay. So with investors, you're gonna hear about 1031 exchanges, right? So that's another class that we'll have. Okay. For 1031, remember there is no 250 exclusion, right? What they can do is do a tax deferred exchange, right? Okay. Otherwise, they pay those taxes. Okay. All right. Let me see. What else do we review? Oh yeah. Let me show you this one, right? Okay. So as an investor, right? All related expenses are deductible, right? If you have a rental property, right? Depreciation expense. What is this, right? I was talking to an agent yesterday about should they convert their property into rental or sell it, right? Because they want to buy something else. Well, we came to the conversation of, hey, maybe you should rent it out, take a loss, and have this depreciation expense. So what is depreciation expense, right? Basically, if you have a rental, the IRS says that if you invest in real estate, they take the improved value, the structure, whatever that value is. So Mike's property, let's say 300,000 is structure, 200,000 is land. So you take the $300,000 price, right? Because you bought for $500,000, 200,000 of that is land, so you can't depreciate land, right? But you can depreciate the structure, because technically that's what we call paper loss, right? So you take that 300,000 divided by 27.5 years equals your yearly deduction. So for Mike's property, if he bought that as a rental, he will get a roughly about a $12,000 deduction every single year for the next 27 years. So basically 12,000 or less on his income. So if his income was 100, he's now going to be taxed at 88,000. Okay, if you didn't catch that, you'll catch it on the recording, hopefully, right? Or maybe tomorrow will be clarified. Okay, so that's how tax deductions work. So that's why you invest in real estate. Okay, so again, our goal tomorrow is how to lower our adjusted gross income, right? Because we get a 1099 or a W-2, how do we lower it, right? And as a real estate agent, we have the most deductions available to anyone, right? Because with real estate, we can deduct almost anything, right? We have to make it ordinary or necessary. So we're gonna think about that tomorrow, right? So I told you guys, one of your homework is to figure out, how to avoid paying any tax, right? Property tax, income tax, capital gain tax, right? So think about that. What are those, right? And we'll see if that's true or not, right? And then of course, for your homework today is figure out what do you want to deduct tomorrow, right? If she wants to deduct her haircut, how can she make that deductible, right?
I wanna know
Right?
that.
Yeah,
Right?
make a nail.
Right? So there's certain things, right? Like Mike's suit, right? He goes to a listing presentation in a suit. How do you make that tax deductible?
Oh, wow, I could do that too.
I didn't say you can, right? I'm saying how do you make something like that tax deductible? There'll be ideas, but again, it's up to you to figure out if you can deduct it or not. Okay, right. So again, we'll talk about all of these when we talk about dealing with investors. Okay. All right. So any questions so far from what we've covered, or anything I need to repeat? Blaze, Vishal, Maria, Avatar from Zoom
No,
room.
it's pretty clear. Thank you.
Okay. Aparana, any question? What's the question?
Yeah, I was asking you, just telling me the like depreciation. You can take a depreciation for 27.5 year, whatever is the value of the property
The
is.
improved value.
The
The improved value.
the improved
structure.
value, right?
So where do you find that? Let's say where do you find that, right? If you
I
look at your
found
if you
I
look at
found
your
it from
props,
the property tax yesterday. I got my
yes,
property tax bill yesterday,
yeah, that's
and
where you see it, right?
I saw that what is the value of my land and what is the value of my improvements,
Perfect, right?
right?
So, mhm.
So I was just my question is like, if you think that okay, if I buy a new house uh, and rent the one that I'm living in, I can
Mhm.
use as a deductible, but the income that comes if I'm using as a rental, that will also, if will also add up to your income, isn't it?
Yes, correct. Yeah, yeah. If you get rental income, that's income, right?
Yeah.
So now you have to figure out how do I deduct that. That's why I have some clients who are high earners. They don't want income. They say, I just want to break even. I can even do the loss because I have other income to defer it against, right? Okay.
Mhm.
Again, our goal is to lower our adjusted gross income.
Okay.
Okay. But also remember, we have AMT. Okay. Some of you guys don't know that, but once your income hits a certain level, you have an alternative minimum tax that you have to pay, right?
Okay.
See, for instance, you know, our previous president, Donald Trump, right? He had like I think over $200 million loss from a property that he could carry it over. So that's why for the next like 20 years, he doesn't have to pay any tax. And people are like, oh, that's impossible. He earns so much. Why doesn't he? Right? For instance, Elon Musk, right? Well, I'll say this for tomorrow, I think. Elon Musk, right? He owns Tesla, right? How does he pay such little tax? There's certain ways to do it. Okay?
All the big people, they don't pay taxes. Only the people
No,
who works W-2
no.
people pay the most taxes.
See, that's another conversation we can have another time. Okay, off this recording. But okay, so any questions? Any questions? We
Okay.
good?
Can
All
we
right,
send me?
okay.
Should I text you for the recording of this?
I'll send this out either tomorrow or or by this weekend. All right,
Okay.
including the property tax stuff, and then including tomorrow's class on income tax. So, any specific questions before I take this offline, and then I'll answer some more questions that won't get me in trouble.
Sure.
We're good. Okay, I'm gonna stop. I'm gonna stop my share real quick, and I'm gonna stop the recording.
The women's might be different. Yes, I would ask the front desk.
the
Yeah.
building number,
It's the building number?
yes.
Okay, thank you.